The European economy in mid-2025 presents a complex and unsettling picture. Forecasts point towards sluggish growth across the Eurozone, reflecting deeper structural issues. There is a heightened risk of prolonged stagnation. Analysts warn of a potential policy-induced recession. Global conditions provide little comfort for Europe. Financial markets signal investor nervousness. Private sector confidence is declining. The euro area might narrowly avoid a technical recession. Near-zero growth is cold comfort. A dual-track economy means vastly different realities. Understanding these forces is crucial to grasping Europe's economic rollercoaster in 2025. One of the most significant headwinds battering the European economy in 2025 stems from new U.S. tariffs. European manufacturing, particularly auto-related exports, is vulnerable to these protectionist measures. Beyond the direct cost of the tariffs, the broader trade policy uncertainty they generate acts as a major drag on investment and growth. Persistently high energy prices, a structural impediment since the halt to Russian gas supplies in 2022, continue to burden European industries. This energy cost differential particularly squeezes manufacturing firms, eroding profitability and hindering global competitiveness. Fiscal pressures loom large, especially for core economies like Germany and France, leading to expectations of significant fiscal tightening. The manufacturing sector faces intensified competition from China, further complicated by the global economic slowdown. The U.S. economy, a major market for European exports, is also experiencing disruption from its own tariffs, creating a ripple effect that constrains Europe's industrial outlook. The concept of a dual-track economy within the Eurozone is becoming increasingly evident in 2025. Core economies like Austria, France and Germany are struggling with low growth rates and fiscal pressures. In contrast, peripheral economies like Greece, Italy, Portugal and Spain are demonstrating relatively better economic performance. Southern European countries in particular are showing more resilience due to a strong services sector and positive net immigration. Strategic investments funded by the EU's Recovery and Resilience Facility are beginning to bear fruit. However, peripheral economies remain vulnerable to external shocks, particularly trade disruptions. Across the Eurozone, the labor market is showing signs of strain, with rising unemployment and moderating wage growth. This combination could dampen consumer spending, a key pillar of economic recovery, affecting both core and peripheral nations differently. Germany, traditionally Europe's economic engine, finds itself in a particularly difficult situation in mid-2025. The country has been mired in a recession for 2 years, with more company closures than during the 2011 financial crisis. Persistently low growth, significant fiscal pressures and high electricity prices plague the German economy. The German Council of Economic Experts projects stagnation, or zero growth, for 2025. In response, the new German government introduced an urgent recovery program in May 2025, including plans to reduce the electricity tax for industries and reform the labor market. A substantial €500 billion infrastructure investment package has been announced, but significant positive effects are unlikely before 2026. France faces similar challenges, with low growth and high fiscal pressures. The French government is expected to implement fiscal tightening measures, which could further constrain domestic demand. In contrast, Spain is performing relatively better, with a forecasted GDP growth of 2% in 2025. Spain's resilience is supported by a robust services sector, continued benefits from EU recovery funds, and a more dynamic labor market. To navigate the turbulent economic waters of 2025 and beyond, European policymakers must prioritize reforms that enhance economic flexibility and resilience. A key focus should be on stimulating domestic demand across the continent. Policies should aim to empower consumers and encourage business investment within the Union. For Germany, promoting a transition towards new, sustainable business models is crucial. The substantial €500 billion investment package must be strategically utilized for genuine structural modernization. Labor market reforms should focus on more flexible working hours and increasing female workforce participation. At the Eurozone level, monetary policy will continue to play a vital role, with the European Central Bank expected to cut interest rates further. Beyond monetary policy, there is potential for increased EU-level investment, particularly in areas like common defense spending. Regulatory harmonization across member states could reduce barriers to trade and investment within the single market. European leaders must collectively acknowledge and adapt to the changing global trade landscape, developing a cohesive strategy to navigate this new reality.